We're here with Charles de Vaulx, manager of the IVA International Fund and a renowned investor for many years. Now, Charles, your fund has the virtue of being able to go anywhere in the world, but many people are looking at the investing landscape right now and they see stocks are at least fairly valued. Corporate bonds had wonderful yields for a while there. That's come down. And sovereign debt, as we know, has a lot of problems, mainly the indebtedness of so many countries. So where do you go?
Well, one of the options when you have a go anywhere fund is to have cash. So indeed, you're right. Sometimes asset allocation does not work once every 30 or 50 years because at times every asset class has been bid up. In '07, small stocks were as expensive as big, high yield, commodities, even gold, the insurance policy had gone up. So we have the flexibility to be in cash. 2 months ago, we had 22.5% in cash. Markets have come down over the past 2 months. We've been able to do some shopping. Now the cash levels have come down to 13%. The fact that we're not fully invested tells you that we still don't feel 100% comfortable with what's out there.
And you are a fan of Europe, which, as most people think, is falling apart. Why would anyone put money in Europe?
Jack, I'm not a fan of Europe. I'm a fan of the prices at which certain securities in Europe. It's important to understand that in Europe has many companies that are very global in scope, even more multinational companies than we have here in the United States. And some of the companies we own in Europe are companies such as Nestlé, the food company, a multinational company, Total, big global oil company. Even French-based Sodexo owns Marriott services here in America, so that 40% of the business is right here in the United States. So a lot of European-based companies may not necessarily do a lot of business in Europe. But then even for the companies that are Eurocentric, the price matters as much as the outlook. So the outlook may be bleak, but it's important to understand that European stocks today are a lot cheaper than US stocks, and so some stocks are attractive just based on the price, even though the short-term outlook is not too inspiring.
That's true. So let's talk briefly about gold. I know before you ran this fund, you did run a gold fund, so you have many years of experience there, and you do own some gold now. The price has gone up a lot, though. You're a value guy. What do you feel?
Yes, you're right. The price of gold has gone up from $255 in the summer of '01 to $1240 today. Now, the good news is that in the '70s, gold went up 20-fold. And so we may not be totally done with the move in gold. More importantly, we think that there's so much debt in the system that it's very tempting in many countries to try to inflate away. It's easier to inflate away by printing money than taxing people or reducing spending. One of the traditional knocks against gold is that it pays no interest. That knock is a lot less relevant when nominal interest rates are very low and when real interest rates minus the inflation are negative, which is the case today.
Thank you very much, Charles, and thank you for watching.